Welcome to Growth TV. I'm Carolyn Vallejo. Asset prices are responding to ongoing market pressures in some surprising ways, driving LPs to rethink their exposures and fueling interest in the secondaries market. Here with me to discuss the secondaries opportunity is Cameron Joyce, head of private equity at Preqin. Cameron, welcome to Growth TV.
Thanks for having me.
So, how have asset prices responded to things like higher interest rates and ongoing market uncertainty?
Well, it's certainly been quite a bumpy road. I mean, if we go back a few years to the outbreak of the pandemic, of course, we saw that very sharp sell-off in public equity markets. And there was a lot of expectation about what would happen next, and particularly in the secondaries market in particular. We did see a spike in demand for secondary strategies because a lot of investors were expecting that those strategies would do particularly well in that environment. And to some extent, that didn't really play out because, of course, we saw these very powerful stimulus measures coming out of the Federal Reserve and the Treasury and elsewhere globally as well. So, of course, we've seen this very, following the pandemic, we saw this very strong run up in risk assets, which meant that actually the deal-making environment for private equity generally was very, very strong. And it's probably fair to say that the activity levels that we saw were almost turbocharged. I mean, we had so much cheap money going through the system. The velocity of funds coming in terms of fundraising, deal flow, financing, and exits were very, very strong. And I think what was indicative of that environment was the fact that we had this SPAC boom where a lot of this cheap money was finding its way in there and really helping the exit environment by helping some of these, particularly venture-backed companies, exit the companies. Obviously, that all came at a cost. I mean, this stimulus was very, very different to what we've seen over the last several years, where we've seen Federal Reserve quantitative easing, which essentially, to a large extent, is a balance sheet phenomenon. It's boosting the amount of reserves that are held on the balance sheet, but not much of this liquidity was actually getting into the real economy. But what we saw post-pandemic was the fact that the government was essentially putting money directly into the hands of people, and that was very inflationary. So obviously, we've seen inflation come through. And in response to that, we've seen arguably the fastest pace of rate increases that we've seen, especially when you take into account the level of financialization in the economy as well. So it's fair to say that markets are having a hard time of digesting that because we've had an environment now for so long where rates have been incredibly low. But now it's starting to be priced into private market assets as well. By comparison, public market assets don't take that much time. I mean, we've seen the sell-off in public equity markets and actually subsequent recovery that we've seen coming out this year. But of course, if you look at public fixed income markets, we've seen a lot of hurt really in the fixed income market. So generally speaking, that's how we see it. It's fair to say that for private market assets, I mean, given the way they're valued, it will take some time for those rate increases to essentially be priced in effectively.
All right. So why has there been so much attention being paid to the secondaries market? And what are some of the opportunities you're seeing there?
Well, you're right. I mean, I think from our perspective on the research insights team at Preqin, it's probably one of the areas where we've fielded the most inquiries this year. And that's for a number of reasons. I mean, firstly, looking at this from a market observer perspective, the secondaries market is incredibly interesting because it tells you something about the pricing of assets. And one of the things that's been happening is, of course, as I said, public market assets have sold off relatively quickly. Their valuations have gone down, but it does take some time for that to feed into private market assets. So what happens in the meantime is you have a bit of a disconnect between public and private market valuations. And that really manifests itself in the secondaries market because you start to see discounts from NAV, and you start to see lots of interesting activity. So I think firstly, from a neutral observer, people are looking at that space, trying to figure out what's going on. But at the same time, the secondaries market is also set up for a significant increase in the level of activity. So firstly, we have LPs or investors who are increasingly over-allocated. And by that, I mean there's an increasing portion of LPs out there who are over-allocated to private markets. And that was something that was exacerbated for some with the denominator effect, because by definition, of course, if your public equities and your fixed income portfolio sells off, then the percentage of your private equity portfolio by definition increases. So some of those investors found themselves going to the secondaries market looking to trim their allocations. And on top of that, we have started to see an increasing number of LPs who are going to the secondaries market really for portfolio management reasons. And this is something that we haven't typically seen in the past, but essentially opportunistically trimming positions, especially if they may want to redeploy that capital into a more recent vintage. So a lot is happening on that side. At the same time as well, on the other side of the equation, we've also got the GPs. So GPs obviously looking to raise their next fund. In order to do that, they need to show their LPs that they have good distributions from the existing vehicles. But that's particularly difficult in this environment because we have a very, very poor exit environment, which is really the polar opposite of what we saw when the SPAC phenomenon was taking place. Now it's actually very, very difficult to IPO and other forms of exit activity. That's actually where we've seen the sharpest drop off in activity. So if you're finding it more challenging to exit, one of the ways in which you can mitigate that concern is by using continuation vehicles. And that's why we've seen a lot of interest in those structures this year in particular. It obviously offers a lot of flexibility on both ends. I mean, you're essentially allowing the LP to decide whether to roll over into the new vehicle or to take that liquidity. It helps the GP not have to actually sell the asset on the market, perhaps at a distressed valuation. So there's a lot of positive factors that are setting up a lot of the activity in that space. Now, I think the challenge that space has seen is the fact that in spite of that potential deal flow that's been coming to the table, not all of it has been transacting. And it really relates to what I said before about the discounts, because if you're if the asked for discount is 20-30%, it's more difficult for that transaction to clear. So particularly in the first half of this year, we didn't really see as much deal flow as many people had anticipated. And it was actually a decline on what we saw the same half of the year compared to the year prior. So I think in some respects, the market's set up for a lot of activity, but we haven't necessarily seen it come through. But there's a number of reasons why there's a lot of attention on that space at the moment.
Mm-hmm. There is opportunity there, as you just mentioned, and you touched on this a little bit, but tell me more about how allocators are kind of positioning themselves as a result of some of these trends that you just mentioned.
Well, firstly, it's ironic because, as I said, you've got an increasing portion of LPs coming to the secondaries market to sell private equity exposure and private capital exposure. But at the same time, we've also seen an increase in appetite for private equity secondary strategies. And that's really, again, in anticipation of the fact that it's going to be a good environment for those funds to operate. And if you look at Preqin's data, performance data on secondaries, there is evidence that suggests that in relatively distressed financial market conditions, you do see better vintages, essentially. So if a vintage is born into a relatively distressed market environment, that's where the manager can go in, find good opportunities, buy good quality stakes of funds at a discount to their true value. And that's arguably why that's an attractive strategy. And then on top of that, you've got a lot of long-standing attractions of the secondary space. I mean, particularly for relatively early stage LPs, they like the fact that when you go into these strategies, you have visibility on the portfolio because it's already invested. And also you mitigate the J-curve effect. So, I mean, you don't have to wait for that effect to play out. So there's a number of attractions there that are both structural and more temporary. So that's one area. I wouldn't say that's necessarily the main difference that we've seen. If we look across private capital overall, our investor surveys indicate that we have seen a softening in risk appetite across the board. Although the most recent survey that we did in June and July this year did show a slight warming of sentiment, but bear in mind, this is coming off a relatively weak environment. So on the one hand, we have seen that decline in risk appetite, particularly for the higher end of the risk premium, so private equity, venture capital. And generally speaking, we've seen preferences shift more towards real assets and away from those PVC sectors. So broadly speaking, that's what we're seeing. On top of that, I think direct lending is arguably one of the strategies that especially at the start of the year, was very, very well set up because, of course, it's by nature, it's floating rate exposure. So as interest rates go up, you get that yield pickup as well. It's relatively simple. I think in addition, when we saw the issues coming out of the US regional banks, the willingness of the banking system to step into that lending space were diminished somewhat. So we've seen direct lending strategies step in, and that's an opportunity for them because it's a less crowded space. So there's a number of reasons why direct lending is attractive in this environment, and I think that only acted to enforce that further as well. I would say one more thing as well. We have seen an increase in appetite for distressed debt, and this is arguably in anticipation of what might come next in terms of the financial market cycle. So I think it's fair to say that everything we've seen so far, or most of what we've seen so far, is essentially financial markets pricing in this new interest rate environment. So you could essentially say that that's duration risk being priced in, but we haven't seen any significant credit risk yet. And hopefully we don't. I mean, hopefully the economy stays relatively strong and that won't happen. But I think in anticipation of that potentially happening, you are seeing more LPs starting to allocate to these distressed strategies, because of course, if that does play through, then those strategies will be of interest.
Mm-hmm. Certainly several trends there to continue watching closely as we move towards the end of the year. Cameron, thank you so much for joining GrowthTV and sharing your insights with us.
Thank you.